Welcome everyone. It's yet another interesting time with us on TWI. TWI is the Wealth Institute channel on YouTube. All right. So the last time out, we started a series on how you can build wealth, how you can make millions. I mean millions, investing in the stock market. And last time out, I told you that investing in the stock market is not as risky as it is painted by a lot of analysts, a lot of investors. All that is required for you to succeed in the stock market is for you to understand how it works, understand how to determine which stock is a good buy and which stock is not a good buy. So in the last video we did, the introductory video, we introduced the subject of fundamentals, and I defined what fundamentals are. In case you are wondering what are fundamentals, please go and see that video. It's on our channel. Go and see that video. I gave a detailed explanation of the subject matter of fundamentals. And so today I want to delve into the fundamentals proper. Okay, so in the last video we mentioned that the fundamentals to look out for in a company include profits, its profitability, the revenue, that's the turnover of the company is important. Every company needs cash flow. So the turnover, the liabilities, that's the debt, the assets of the company. You want to look at, does this company have assets? Why? Because it tells you how it's able to pay off its liabilities in the event it runs into problems. Okay, one or two problems. If the company has robust assets, then that can serve as collateral for the liabilities if things go wrong with the company. And then you are looking at growth potential. Why is growth potential important? Growth potential is important because everybody wants their money to grow and appreciate in value. So if you are buying into any company, you want to be sure that 5 years down the line, the share price of this company would increase significantly. And of course, if the share price increases significantly, what it means is that your investment has also increased in value. It's as simple as that. So if you bought shares, say you bought 5,000 units of shares at 10 naira, and 5 years down the line or 2 years down the line, the share price goes to, let's say 50 naira or 100 naira, or more, this thing don't multiply by 10. So that's what we're talking about. So you want to be sure that the company has growth potential. It's not greed, it's business. You are there to make money. It's better than stealing, okay? So today I want to look at what is called debt to equity ratio. Debt to equity ratio. Don't worry, like I always say in our videos, don't allow the grammar bamboozle you. So what is debt? The Hausa people call debt bashi. The Igbo people say ogwo. That's owing money or owing something, right? So debt is simply what is owed to another. Some Nigerians call it debt. It's actually debt, okay? That's on a lighter note. So debt to equity ratio. So debt is what is owed. Equity is the total value of monies that investors have put into that business, okay? The total values of the money that people, investors, people like me, people like you, hopefully, if you have not yet started, will be putting into companies that are quoted on the stock market. That is what you call equity. So the debt to equity ratio is a very important fundamental to look at when you are buying into a company. There's a simple formula. The experts have formulas for virtually everything, right? The experts have a formula for debt to equity ratio. It is total liabilities divided by total equity. Liabilities and debt are the same thing. Don't get it twisted, okay? When we say debt, we're talking about liabilities. All right. So total liabilities over total equity. That is what gives you the debt to equity ratio. Very important. Why are we looking at this? We're looking at it because the debt to equity ratio tells you how well or how much a company depends on its own resources for its day-to-day running, or whether it's dependent on outside resources for his day-to-day running. Now, if a company has a low debt to equity ratio, that company has a good fundamental. It is good. If a company has a debt to equity ratio of say 0.27%, 0.27, yes, 0.27% or 27%, depending on how you look at it, 30% and below. Some experts say 40% is fair. It is low. Okay, but if a company has debt to equity ratio of 60%, 70%, it means that the company is dependent on outside money, and that is a red flag. Okay, you need to be careful when you need to look at all the fundamentals before you now say, I'll buy this company. Okay, but if the debt to equity ratio is reasonably low, I gave you examples: 30%, 27%, 20%, 25%. Because you see, you want to be sure that the company you are investing in has enough money. If they have enough money, they can run their operational expenses, okay, and they are not affected so much by interest rates and all of that, because companies need to borrow money from banks and all of that. So you want to be sure that this company is not heavily dependent on borrowing, because if they are heavily dependent on borrowing and the interest rate is high, it means that the profits they are going to make using the borrowing is going to be small, because by the time they pay high interest to whatever source they got the money from, they will be left with little. And if they are left with little, there is little that will come to you. So that is the implication of this debt to equity ratio. I hope that makes sense. Now, you also want to look at the nature of the debt the banks are, or the companies are taking up. Okay, are they long-term debt? Are they short-term debt? So it's one thing to know the debt to equity ratio. It's another thing to understand the nature of the debt they are incurring or they are taking. Are they taking long-term? Are they taking short-term? Long-term debt is riskier than short-term debt. So when you are looking at the balance sheet of the company, or when you study the minutes of their annual general meeting, you want to pay attention to those details, because those details will be there. The kind of debt they are taking up, short-term or long-term. If it's long-term, it's risky. That can have a toll on their bottom line at the end of the day. And if their bottom line is affected, their profitability will be affected. If their profitability is affected, your dividend will be affected. I hope that makes sense. So that is debt to equity ratio. Another small one I want to talk about briefly before I round off is what is called capital adequacy ratio. Capital adequacy ratio. That one happens a lot with bank stocks, but it is also applicable to every company. Okay, and by virtue you are here listening to me and you own a business, you can start applying these principles to your business, as small as it is. And they tell you, you can start applying it. Before you know, you become big, and maybe one day will come and buy your shares. So capital adequacy ratio tells you how well a company is able to meet its financial obligations. How well a company is able to meet its financial obligations. And the good news about these things I just mentioned is that if you go to the company's website, all this information is available. So you don't need to break the bank. You don't need to break your head to get this information. They are there. Do you know why they put those information there? Companies that are doing well will put it out there because they know that those that understand stock market investment will be looking out for those things. So if they hide those pieces of information, it means they have something to hide. And if they have something to hide, people will hide their money from them. So on that note, we have come to the end of today's short video on fundamentals. Today's fundamental we dealt with is debt to equity ratio. Okay, so in case you have not yet subscribed to our channel, person, you need to do us well. Go and hit. If I hit it right now that you are watching this video, don't procrastinate. Don't wait till tomorrow. Hit it now. Okay, don't be say I force you, but you're my guys, you're my people. So hit the subscribe button, like our videos, share it. We are giving you these pieces of information on a platter of gold because we want you to succeed financially. We want to see a better version of you. I will be glad to hear from you. If this series is adding any value, please put a comment in the comment section. All right, and then give a like, give a thumbs up to this video. So thank you for spending time to hear out our content. We are sure it has added value to you. So until we see you in the next fundamental discussion, have a good time. Bye-bye.